Right now, the housing market remains white hot in the Coachella Valley, but are things expected to cool down once the pandemic ends? And could there be a real estate bubble? I spoke with Bob Marra, the CEO of Marra Market Intelligence, a local business news and economic research company. Bob, thanks for joining us again.
Hi, Peter. Thank you.
Boy, this is certainly an interesting time for the housing market. And as we head into spring, how are things going in the local residential real estate sector here in the Coachella Valley?
Well, let's put it this way. First of all, it's a seller's market still. And the reason for that, the main reason, is there's not much to sell. At the beginning of March, 902 units of combined single family housing and attached housing, which is condos and townhomes. So there's not much to sell. So we know the principles of supply and demand are at work. And the demand, while it has slowed in December, January, and February compared to all the action going on in the spring, summer, and early fall, still a seller's market, and prices are still increasing. As an example, the median price of a single family home hit $527,000 in the month of February here for the Coachella Valley for a single family home, and detached, and an attached condo unit about $431,000 as a median price.
Wow, that's a big difference compared to this time last year.
It is. It's 22% increase on the single family side. So if we just stay there, a house was worth about 430, now worth 527. So if people just stayed in their homes and were at that median kind of a style home, in terms of what was sold, they made 100 grand just by doing nothing, by owning a house.
Incredible. With such a hot market right now, what are some of the challenges ahead?
Well, I think the challenges the potential pitfalls could come and hit us, but it doesn't appear that we're going to have too much. If we look back at, let's say, a real estate bubble that we had that actually precipitated the Great Recession, these were tricked up loans. They were non-statement of income. Anybody could get a $380,000 home, put a second on it, and build out a pool and throw marble all around. And then they found out that they couldn't pay for it. And so we all had to pick up the pieces for 4 and 5 years. This is just real demand. The credit standards are challenging. The down payments are challenging as well. And so these are real sales that have happened, a lot of it from outside the market for the reasons that you've been covering and we've been talking about for a long time, people wanting to get out of the urban areas. And so the demand has been real. It's been robust, but I think it's slowing down a little bit. And at the same time, there's not much on the market.
Yeah, I was just about to ask, now that the pandemic is sort of drawing to a close, what can we expect for the rest of the year? And is it possible that there could be a real estate bubble?
It's possible. I think the good part is that I think we'll just see a pretty flat year. You can't have 22% appreciation on existing housing prevail over multiple time. If we look back at a 50-year window or even 2030, it's 5%. That's what you expect on residential, right? And so 22 is an anomaly. And so I think as buyers from outside the region do their homework more, they get a little smarter. Even if we get more inventory on, it'll still stay pretty stable, maybe up a few percent. I think interest rates are a key factor. We keep hearing from the national authorities that interest rates look like they'll stay pretty level for the next couple years. So I think that helps us. And so then what we'll need to see is, what about locals and even people from outside the region maybe didn't want to come here and sell a home during the pandemic, maybe some Canadians, maybe people from the Midwest, and they might come back and put their homes on the market, which will be just fine to provide more opportunity for people to buy. And so I think we should be okay on that. And a lot of the people, a large portion we're finding are buying homes with cash. And so interest rates, even if they did go up enough to hurt other markets, wouldn't be as much of an impact for ours.
Okay. Bob, we appreciate your time. Thanks again for joining us.
Glad to do it. Thank you, Peter.